Are you sometimes thinking, hey, I want to buy that stock, but I don't know at what price? Did you ever buy the top and sell the bottom, purely based on emotions? Well, today we are going to stop that. You are becoming a serious investor that doesn't chase the price, that doesn't watch the price every day. No, before you are going to buy, sell, you are going to determine your price ranges. When are you going to buy the stock? When are you going to sell the stock? So in this case, we are going to look at Apple stock, and I'm going to decide if I wanted to buy Apple, at what prices I would buy in. And Warren Buffett is doing the same. This is how serious investors scale into a stock or scale out of a stock. So let's start. What most disciplined investors think, hey, price moves are noise, valuation is a signal, decisions are made in advance. Now, the good part is we have all the data, we have the financial reports, and we calculated a lot of ratios on it. So, and the three ratios I'm having in this tool is the price to earnings ratio, price to cash flow ratio, and the price to book ratio. Based on those ratios, you can determine what is a good price based on the earnings, cash flow, or the book value. So, what we first are going to do, we are going to fill in this form. We are going to fill in a price range from, well, let's say $10 to $1,000. Well, we know the stock Apple is around 255 today. If you are watching it later, but prices move every day. Eh? So we are filling a price step of like 25. Okay. As you can see, we get a lot of data now. And well, we know it's around 250 now. So it's between, we can make the step $10. So let's assume we are now at $250. The stock price is $250. What we have now, a price to earnings ratio of 31.4. Okay. And the price to cash flow is 13.7 and the price to book value is 40.1. Now, before you are going to use this tool, you have to learn what those ratios mean, but you just type it in YouTube and somebody will explain it to you. But after that, you can decide for yourself, or maybe you know those ratios already. I hope you do, because that's a good sign of a serious investor. So what I can do now, well, you probably have a price to earnings ratio in your mind. Hey, below that is becoming cheap, and below that is becoming fair value. So, for example, I will put a price to earnings ratio when it becomes cheap is like, well, maybe 30, of a fair price 30, cheap 15, and then you can calculate again, and you see what happens. You get a price range based on the ratios that it's your assumption, your valuation, it's fair value or cheap or expensive. So in this example, it's an example, we are slightly overpriced. So as a serious investor, I'm not going to buy here. Okay. I'm going to set not a price target. No, I'm going to set a ratio target. Okay. I like Apple stock. I want to go in, but I'm not going to change the price. No, I'm going to wait for the price to come into my price targets. And if it doesn't come there, I won't buy it. You see that often with Warren Buffett and co and other value investors. They already know when they want to buy the stock, at what price. They just sit back and investigate all the companies, and they make a list. Hey, these are good companies. I want to scale in here, and then they just wait. They wait until the price comes, maybe a crash. Um, somebody, well, maybe the stock prices are going down. Hopefully, a crash. Well, that are crazily good opportunity to buy into a good business. So, like you can see here, we have green that is cheap. No, this is a bit orange. I'm colorblind, but and red. So what you can do now, okay, you can determine a price range for yourself. Like, okay, um, well, the price to earnings ratio is here at 20. It's $160. Denke, Apple stock will never go to $160. You could never buy there. Well, prices do collapse sometimes, and then you want to strike. If you want to buy the company, of course. So, what are the steps you want to do to buy a stock? Well, step number one, you analyze a stock. If it's a stock you want to buy. Second, you calculate the intrinsic value of a stock, determine 10-year or 20-year price range, and then you have kind of an idea, okay, this company is worth X amount per share. Then you are going to use this tool with the price ratios you assume, and then you determine a beautiful price range. Hey, I'm going to scale in between $160 and $200 if the price comes there. If it doesn't come there, I won't buy. Well, and suddenly we have a crash. Price goes to 180, we buy a few shares and we are pretty happy. If it goes lower, we buy a bit more. Don't buy all the eggs at the same time. And then you are comfortable. You are in a great company on a fair price and you are pretty happy. Well, and of course, prices will go up again and suddenly we are at 300 and you think, hey, it's now overvalued. I'm scaling out. That's what serious investors do. So one more important note, those ratios change every quarter. After each earnings report, they change. So your price ranges, your buying and selling price ranges also change every quarter. You have to stay actively updating them, else you could be buying at the wrong prices. Do you like this and want more tools like this? Well, take a look at my website, pankeinvesting.com, or subscribe to the channel because I will make more videos for you. Bye.